Welcome to my channel. I'm Dr. Romano. Today we're going to be discussing whether or not hedge funds are losing their grip on the markets. Something changed around 2009. After the collapse of the investment banking sector, the investment banks started to invest heavily into hedge funds. That changed the hedge fund industry because all of a sudden, around 2012, 13, 14, around there, I'm not sure the exact year, so don't hold me accountable, but there was a lot of money poured into hedge funds. And hedge funds became even bigger than they were. Overnight, you've seen funds of funds grow too in that time period, especially now. The hedge fund industry is not losing a grip on the markets or perfecting their returns or producing really outstanding returns. It has nothing to do with their high fees. Everyone calls it high fees, 2 and 20%. What changed is that larger funds got larger and smaller funds got larger. According to my Ph.D. research, I'm Dr. Hedge Fund for a reason. My Ph.D. is all about financial management and leadership, but my research that I specialize in, 1,000 pages, is on hedge fund selection. And so I've ran the data through, up and down, left or right, every possibility. I analyzed it and I improved it. So a hedge fund is an investment company, and you have a trader that makes bets on the market. What is happening now is when a company becomes too big and they have 500 or 100 employees, the quality of the company diminishes. And in my data, I noticed this, and there is an imaginary roof, and that's around 350 million. Once a hedge fund becomes or approaches 350 million, their returns start to get watered down. So what does that mean? Well, it means keeping the company smaller, don't hire hundreds of employees, keep it 1 or 2 people trading capital, and that's it. So if you think about it, the actual markets as a whole will be much more efficient, because when you have thousands of traders trading the market separately with their own LLC, meaning their own investment company, they're the leader, they're the owner, they take responsibility into their own hands, which produces value. Because they realize that if they make a mistake or they don't tweak their strategy, they're not going to be in business. So these larger funds, they have traders trading for them now, and they're repeating exactly what the investment banks did. The sloppy traders at the investment banks produce puny returns, and now the hedge funds are repeating what the investment banks are doing, and they're producing puny little returns. It was better to stay small than continue to grow. So my advice is to reinvest the capital into multiple traders, allowing them to take the responsibility into their own hands and tweaking their risk management strategy, their trading strategy, and their ability to trade. In this way, only the best will stay in business. Before we continue the video, please remember, if you want to say thank you, Anthony, do thumbs up. It's just right there. Thank you so much. I really appreciate this. Because you can't say the dominant one is going to stay in business, because just because the dominant one is the dominant one and takes over the group, it doesn't mean that they're really qualified to trade. In other words, I had another video that discussed why is it that the dominant person always seems to move up? All right. So the dominant person, what are they actually good at? They're good at getting rid of their competition. So that means that all the people around them were actually more qualified than them. That's what happens with management. The quality of management gets watered down when you have the employee structure. So if we go back to having smaller hedge funds, like in the year 2000, between 2000 and 2010, it produced a better outcome, and that's the actual return. Now, you can't come up with a graph and analyze all the hedge funds and clump it together and then use that return as whether or not hedge funds are outperforming the markets or not. Not all hedge fund managers and all strategies are going to do well. It just depends the strategy, the market that they're trading in, and everything that's putting the puzzle together. Some strategies need high volatility to trade to make a really good return. Some strategies don't do well in that type of market. And so that's why if we have thousands and thousands of traders trading the market with their own hedge fund structure, meaning keeping it smaller, our financial markets will be a much better place. Because as you've seen in 08 and 09, what happened to the markets? The markets were terrible. They were so improperly balanced that you had these gigantic traders at investment banks closing out their positions, or making trades and then having to close out their position, and they were ruining it for the smaller people like the average trader. That's my advice, is to, instead of trying to create a gigantic hedge fund with $10 billion of AUM and hiring thousands of employees or even 100 employees, just depends, you need to focus on stop trying to get big, and you need to somehow either create a funds of funds structure. That's what I specialize in, so I know this. And allow those traders out there, go seek them out and invest in them, give them the opportunity to have their own hedge fund. But don't give them billions of dollars to trade. They need to stay small, under 500 million. Of course, a study concluded at 350 million, the returns do get watered down. But there are certain hedge fund managers that are still doing well at 500 million. But the point is that if we give thousands of people, thousands of traders, the opportunity to trade with the capital and to give them the opportunity to manage their own company and the freedom to tweak their strategy, the freedom to come up with new strategies and new ideas, you will produce a better return, as opposed to having a trader work for you in your hedge fund and having hundreds of traders trade for you. You have to remember that an employee loses a quality, and it's not a dominant trait, it's responsibility. They lose the responsibility. Whereas a hedge fund manager who's trading their own capital or the client's capital, and they're smaller, there's only one trader at the company, they're the ones that have to take all the responsibility into their own hands. And every possible angle, they have to think about it, they have to improve it, etc. Whereas when you hire a trader to trade for you at these large hedge funds, they lose that quality. And that's what happened at the investment banks today. You have to question yourself, why did they all go out of business in 08 and 09? Didn't they prepare for a market collapse? It was apparent. The developers stopped investing in real estate 5 years prior. They were not building the smart ones. So if you're a trader on the markets and you realize that your strategy is not working, are you going to continue to place trades? No, you pull back. You don't have to trade every day. It's not going to work every day. Look at my market predictions. These predictions take months in advance to analyze, to see them growing, to see my analysis increasing the probability. And then when I see that it's increasing, then I post my prediction on YouTube. That's what's happening that I've seen in the hedge fund industry. They are becoming sloppy at trading and at managing capital. It's not that I'm not for large companies. I'm simply saying that in certain industries, managing people's assets, you have to be very proficient and very, very logical at what you're doing. And you have to continue to improve your strategy and improve the overall management of the capital. And when the company becomes too big, 10 billion, 50 billion, 100 billion, that's ridiculous. And so that's my advice. I see it in the data because I analyze it every day. And the data is telling me that hedge funds are doing really bad right now. And they're mimicking exactly what the investment banks did in 08 and 09. Again, to improve hedge fund returns, you must keep these companies smaller. That's number one. And you need to keep these traders separate. Don't be trading in a group. That's the worst thing, because when you trade in a group, they're waiting for the other trader to make decisions. And that's what also waters down the returns. Again, you have to understand it's better to have one trader at one investment bank trading and having thousands of hedge funds in your portfolio if you have all that kind of money. So the conclusion is that you should change your structure to a funds of funds structure. Since you do have the ability to raise all that capital, all you have to do is change it. Allow each trader to have their own hedge fund structure. And I know it's repetitive with the administrator, the audit company, the accounting company. I understand this, but that's the only way to subconsciously and psychologically keep that trader in the mode that that's their company and that they have to keep a responsibility going. And that responsibility is producing those quality returns and improve their strategy when it's not working. As the markets change, they're responsible for improving their risk management approach to get out of the losing trades, etc. But when you create a company and you have the leader of the company telling this one what they're going to do and that one no, they're basically trading because they're afraid. And you could see it in the returns. I see this all the time. I noticed a very big difference in the returns at big hedge funds as opposed to very small hedge funds. Those small hedge funds, they're eager to grow. They're eager to perform. They take their job seriously because it's their company. It's different when you're an employee. You're worried about keeping your job. And it creates a bad outcome. I'm not putting you employees down. I'm simply saying that your psychological reasoning changes. And because it changes, you could see it in the returns at larger hedge funds as opposed to these smaller hedge funds with $50 million at AUM or even $25 million AUM. I see it's all probability. And so that's what I'm saying, and I'm not here to put anyone down. Don't get upset. It simply is you're better at managing your own hedge fund than being an employee at another company. You have a fiduciary responsibility, and that's your client's assets. Improving those assets and providing quality returns for your clients. And when you have your own hedge fund and your own hedge fund structure and you're the boss, something ticks in your mind as opposed to when you're an employee. And so that's what's been happening over the past 8 years at hedge fund. So that's the change that's been happening in the hedge fund industry. I want to thank you so much for watching. I really appreciate this. Please remember, if you want to say thank you, Anthony, do thumbs up. It's right there. Just click it. And of course, if you have any questions, send me messages to the live chat so I can respond there, or I'll make an actual video for you to answer those questions. And please remember, if you have friends that want to watch my videos, send it to them. It's the share button. Thank you so much for watching.